Um, so, uh, like I said, cash flow is just one part of the financial aspect. We talked last month about income statement and the financial statements. But cash flow is kind of a different critter. It's a separate animal because cash is the lifeblood of any business, especially small business. I liken it to the gas in a car. I always said that just a car is a collection of systems. There's you know there's the drivetrain, there's the engine, there's the electrical system, there's the vacuum system. Now you got it's a computer on wheels actually. So you got the computer system, and all these systems interact with one another in certain ways. So they all for that vehicle to operate at its optimum, all these systems need to be fine-tuned and working at their best. But the main thing that they all have in common is the fuel of the fuel that runs the system, the gas that runs the car. You can have all these systems fine-tuned and working perfectly, but if your car has no gas in it, not going to go anywhere. None of those systems will work because you won't even be able to turn it on. So that is what cash is to your business. It is the fuel that makes the business go. You run out of gas, your car won't go. You run out of cash, your business won't go. So it is very important. Uh, People have always have asked me through the years, what's the main difference between small business and big business? And to me, the main difference between small business and big business is what we call access to capital. That's access to cash, to money. Uh, Large businesses, big business, they have access to capital. They have the banks will loan them money and other lending institutions without much of a problem because they have just as a rule, they have a lot of assets, things that can back up that loan. So they can get money when just about whenever they need it. Now, small business, different story because they don't have as many assets. You don't have the the customer base that the big business has. So it's bankers and other lenders look on small business as quite a bit riskier. So therefore, that access to capital is more limited. So that's one of the things that you have to be aware of in business or when starting a business, either one. Um, Also, we all, as business people, always want to grow our business. Say, I want to get bigger. I want to do better. And this is natural. But business growth is one of those things that is, it can be very, very good, but also it can be very, very bad if you don't approach it properly. Because growing a business takes money. That's just all there is to it. Because if you want to grow your business, you're going to have more expenses. You're going to have higher overhead. You're going to have add payroll or have more payroll. If you don't have employees, and you're going to have to hire some, or you have to add on employees, that payroll overhead goes up. If you're going to have more inventory, whether it's supplies for making a product or inventory as in retail to resell. Also, sales will lag whatever investment you have in your business. That's just the way it is. You invest your money now, you get it back, hopefully, in over a period of time. And hiccups do happen in business. And I found out through the years there's an awful lot of businesses out there that are just one hiccup away from being out of business. So that's what we're going to talk about. We're going to talk about cash flow analysis because it can be used as an analyzation tool, but also it can be used to look into the future, for forecasting purposes. So we're going to talk about some of these things. If I can get my arrow back, there we go. Kind of the financial statements are, as I talked about, very important. Your income statement and your balance sheet are two things that are used to see how healthy or unhealthy your business is. They are to look at everything and analyze it to make sure you are using your assets properly. Are you turning your inventory at the rate that it needs to be turned? Are you spending the money that you have wisely? Looking at your expense side, which is on your income statement. But the thing about it is those two financial statements do not tell or depict the whole picture of your business. They give a part of your business. And from an analytical perspective, they are very, very good to see mainly how you've been running your business and how it's doing at that moment. But beyond that, you've got to look at and understanding what we call the timing within your business, when things are going to happen or not happen. Income statement, balance sheet, they are accounting conventions, and they are based on what we call the accrual method of accounting. Whereas a cash flow statement is more looks at the reality of the business. How money flows into and out of the business. So and not just it goes in and out, but when does it come in? When does it go out? This is just a quick little example of basically accounting convention versus the reality or the timing of your business. This is Crunchco balance sheet as of, there's a date on there, as of 10/31. So what we've got on the left side, we have assets, and on the right side, you got the liabilities and your owner's equity. Down at the bottom, you'll see that equation, and this is why we call it a balance sheet, is because assets equal liabilities plus equity. And that can mean equity can also be denoted as on here as owner's equity, or if it were a corporation, it would be called stockholders' equity. So on the left side, we've got assets, and we've got cash of $100 in the bank. Now, then below that, we have accounts receivable of $300. Now, accounts receivable, as you recall, that's money that is owed to the business by the customers. You've provided a service, you've sold them a product, and all you've received so far is their promise to pay you at a certain point in time, usually within terms are usually like 30 days. So you've got on Crunchco has accounts receivables of $300, and but that is owed to them by their customers, but that's not due until 12/1. So we got another month. I have to wait on that $300. Hopefully we'll get it in that time. Then we have inventory of $600. So we add that together and that gives us total current assets of $1,000. So our total assets is $1,000. On the right side, we have liabilities there. So our liabilities we've got note payable to the bank. We made a loan from the bank, and we had to pay on that bank loan $200. Okay, that's due 11/1. That's due tomorrow. So we know we got to pay out $200 tomorrow. Then we have accounts payable. Accounts payable is kind of the reverse of the accounts receivables. The accounts payable means that's what you owe to someone else, usually a vendor or somebody you buy your supplies or inventory from. So you owe $100 and that's due on 12/1. Well, thank goodness, we got a month. You're going to be able to use your whoever you owe that money to, going to be able to use their money for another month. So then look down, we have payroll, $100. Okay, we've got to pay our people, or a person probably in this situation, and that's due tomorrow, 11/1. So we add up all the liabilities there, and there's $400. So I know that the total liabilities and equity, it has to equal whatever the left side is of the total assets. So it's $1,000. Therefore, we have owner's equity of $600. So let's look at this situation, kind of do some analysis here. This is some of the things that accountant would look at. Number one is liquidity ratios. Now, liquidity means how quickly you can get cash. Liquidity equals money, cash, more or less. So we're looking at here. First thing we want to, you've all heard, all heard, but very common is working capital. What's the working capital position of a particular business? Well, in this particular situation, the working capital is current assets minus current liabilities equals working capital. So in this situation with Crunchco, they have current assets of $1,000, subtract out the current liabilities of $400, which we got from the balance sheet we just looked at, and that equals $600. So we've got working capital of $600. So we've got should have monies available with which to operate the business. Okay, let's look a little deeper. We've got the current ratio here. And what current ratio is, it's current assets divided by current liabilities. So the current ratio for Crunchco is 2.5 to 1. Now, what's a good current ratio? Now, it will vary by industry, but rule of thumb is if you have a 2 to 1 ratio, that's really good. So what is this 2.5 to 1 ratio? What's it really telling us? Well, what that's telling that is that for every $1 that we owe to somebody, we have $2.50 in the business which to pay that $1 with. So we've got, like I said, if I had a current ratio of 2 to 1, then it'd be for every $1 I owe somebody, I've got $2 in the business that should be able to liquidate and pay that with. So 2 to 1, 2.5 to 1, generally speaking, are very good current ratios. Okay, let's look at what the accountants call a quick ratio. That's also called an acid test ratio. And the difference here is the current assets is you factor out the inventory, because accounts receivable, those will turn into cash pretty quickly, hopefully within the terms of whatever you're offering, like 30 days. Cash is already liquid. Uh, Inventory, you don't turn inventory into money overnight. So it takes quite a while to turn that inventory back into cash, and depends on how many times you turn your inventory over the course of a year. When I had the hardware store, I had to turn my inventory about 3.5 times a year to really be have a good year, be a profitable, at least that. Uh, so here we're got the current assets, $1,000. You subtract out the inventory, which was $600, so that gives you $400, and then you've got $400 in liability. So that gives you a 1-to-1 quick ratio. So what that's saying is, for every dollar I owe someone, I have a dollar that is fairly liquid that I can turn into cash pretty quickly in order to pay that debt. And here again, it's kind of a good quick ratio will vary by industry. 1-to-1 is most always good. But in some industries, you can do a 1/2 is good. It just depends on it will vary by industry, but 1-to-1 rule of thumb is good. So we look at it, we've got a good working capital situation, we have a good current ratio situation, and we got a very good quick ratio from an analytical perspective. But on 11/1, which tomorrow, Crunchco has $300 in obligations that they owe to other people. But how much cash do they have in the bank? Well, if you look back on the balance sheet, they only had $100 in the bank. So, we're going to have to do something. So, we're going to have to uh, come up with some money somewhere. So, how do we do that? Well, that's when we have to look at cash flow and do some forecasting in order to make sure that we don't get into a position like that. What you have to understand on an income statement, those receivables, accounts receivables that you haven't been paid on yet, are considered revenue on the income statement, and they are a component of measuring how well a business is doing, how well it's performing. But in cash flow analysis, looking at the cash of the business, receivables are worthless until they turn into real money. Okay, look at this slide, and this kind of talks about, cash flow activity, where your money comes from and where the money goes. So everything in business, your money comes from or goes to 3 categories. That's operations, investing, and financing. We're going to talk more about those here in a bit. But you see, cash comes from operations and investing, financing of the business, and cash goes out of the business due to operations, investing activities, and financing activities of the business. The one thing I want to show you on this little diagram is, look at the inflow pipe as opposed to the outflow pipe. The difference in size, yeah, that's pretty common in most businesses. You've got more going out than you have coming in. So let's look at how, start looking at this cash flow stuff to see how we can avoid that situation, or to make that outflow pipe, a little smaller. Okay, we've got here, these are sources of money. And so you got collections from customers. That's an operating activity. That's why you're in business. You're collecting from customers, from inventory you've sold them, or from services that you provided to them, and you get paid for that. That's cash sales, collecting those on those accounts receivables. Then we have an investing activity is the sale of a fixed asset. Uh, an example there, and selling a fixed assets are those things that you have and use in a business to help you to sell your inventory, to provide the service. They are should be productive assets. Um, furniture, fixture, and equipment, things like that. Uh, when I had the retail store, I had one fixed assets were the shelving that I had all my inventory sitting on. Also, I had a company truck that did deliveries with and things of that nature. So, but selling a fixed asset, there are good ways to do that, and there are bad ways to do that. Ways you should, ways you shouldn't. An example was when I sold my store, I sold the pickup with it. The person I sold the store to didn't need that company pickup. He had pickups of his own that he was going to use, which is fine. He sold that pickup because he didn't really need it. And he took that money that he sold from selling that pickup, he invested it into more inventory in the store. Okay. That's a good use of selling a fixed asset. A bad way is to sell the company pickup on Friday because you have payroll due on Monday and you don't have enough money in the bank to cover it. That is not a good use of an investing activity. So understanding that just because you can do something, there's not always, you can do the right things for all the wrong reasons sometimes. Another thing is a financing activity is long-term debt. You go to the bank to borrow money. Uh, you borrow, you yourself as the owner invest or loan money to the business. So those are all sources of money, sources of cash. Well, okay, now we have uses of cash. And an operating activity is paying overhead. You pay the rent, uh, keep the lights on, pay utility bills, also payroll, um, for employees or for yourself, and buy supplies. Those are operating activities. Those are activities that you incur in the course of doing your business, of selling your product or providing your service. Investing activity in usage of cash is you purchased a fixed asset. You purchased a new uh, delivery truck, or you can purchase furniture, fixture, and equipment. You purchase useful assets that will help you to either make your product or to sell your product. Uh, these are, like I said, productive assets. Um, another use of cash in a financing activity is repaying a bank loan, repaying your debt repayment, repay that bank loan, money, paying back money to the owner that they loaned, not invested, but loaned to the business. There's a difference there. So those are some different sources and uses of cash. So how do you forecast? Well, it's one of these things that it needs to be a highly educated guess, but you just don't start what I used to call PFA numbers. That's pull from air numbers. You don't just start grabbing numbers out of the air and putting them on a piece of paper. Uh, you quantify them from information that you've gathered for other purposes. Uh, this is why a well done marketing plan is where most all your numbers should come from, even developing your income statement and your balance sheet and your cash flow statement, uh, because it's based on good, should be based on good, solid market research. So uh, that is the place to start looking. Also, look at industry standards, for your particular type of business. You can get online, there's all sorts of associations out there for just about everything, and they'll help you determine, if you're going to have this kind of store, this kind of square footage, how, you know, how many sales per square foot in this particular industry can you kind of depend on, or, uh, determine. So there's different types of things, different types of standards to determine, where these numbers are going to come from. If you've been in business for a while, you've got historical data. That is exactly what you need. So you project out sales, project out your expenses, your cost of sales, what's your overhead going to be. Your overhead is everything from, what it costs you to flip that light on at your store every morning, or every time an employee walks through the door. Uh, so it's going to be a lot of looking, determining, and like I said, if you have a well-done marketing plan, most all your information's there. Because I know that in my marketing plan, I've already determined that I'm going to need a place. Okay, it needs to be this certain size. I've already found a place, and I know how much that's going to cost me every month, because I go talk to that property manager, and he will tell me exactly how much that will cost me every month. So those are some ways to get the information so you can start developing a cash flow forecast. The process is really pretty simple. Fair sales forecast, how much you're going to be selling over a period of time. And that period of time, it could be a month, it could be a quarter, it could be a year. Um, some businesses will break it down to per day. Some will break it down weekly. So it just depends. Uh, but you prepare your sales forecast, then you project your cash inflows and when the money will be coming in. If you're a cash business, and those two should pretty much match up. Project when money is going to be leaving the business on all these expenses that you've identified. When do they need to be paid, and how much over that at those times? Then you just put it all together. See, it's simple, easy, isn't it? Well, it may not be so easy, but it is very necessary. So why do you need a cash flow projection? Well, as you can see here, I think there's a number of reasons. It helps you set goals. It helps you set sales goals. It helps you set expense goals. It puts some parameters into your business, which you need to have, especially when you're dealing with, your money. Because let's face it, money in a business is a resource that is not boundless. It's not unending. Now, there's a it's not infinitive, unfortunately, for most businesses. Also, it helps determine break even point. That's something that the webinar next month on September 17th. we'll be doing the break-even point, going through what it is, what it's used for, and how to. Also, plan your business expenditure. When is that? When are you going to buy things? When is that? When do you have to pay for? So when is that money going to exit the business? And also, uh, that expenditure, what is it more than likely to help bring into the business in the way of cash, and when will that happen? Determining your cash need for inventory, for supply purchases. This was talking about seasonality. It's kind of like I bought stuff when I had the store. I bought stuff for Christmas. I went to a show in the spring. It was always in May. That's when they always had the Christmas stuff out. And so you start planning then, and then you start purchasing through the course of the next 3 to 4 months, because people start, you know, purchasing for Christmas. They don't do it the day before Christmas. So you've got to have it set up and scheduled to start arriving in your store. Then when are you going to pay for it? So sometimes you can get dating. You can get some dating until after the holiday season when you had the most cash, but not always. Sometimes you had to pay it incrementally over a period of time. Are you going to need financing? You're going to have to go get a bank loan, a temporary or a short-term loan from the bank. And if so, when are you going to do that? How much you're going to need? When are you going to do it? When are you going to be able to pay it back? Uh, that last thing is what the banker will want to know. When are you going to pay them back? Uh, but if you have a well-done cash flow projection, a forecast out here, it'll show that lender that you have thought about that, you thought this through, and that you can show him your ability to plan and show your ability to repay the debt. But also, it's just to help you monitor your business as you go into the future. Okay, this is just a kind of an example of a forecast. This is Kathy's creations. Kathy makes products herself and sells them. So she's been doing this for several years, doing it part-time. So now she's looking and said, I want to take this, full time. So she looks at, over the course of a year. Now, remember, again, this is forecasting. We're looking into the future. And seeing how none of us has a crystal ball, we just have to go back and do some research and look at industry standards and use our best judgment, our best guess as to start filling in the blanks here on this template. This is a cash flow forecasting template. So if you got cash sales on the top line, because that's where the money's going to come from, and she's basically it's going to be a cash business. She Under payments there, the first thing is you got cash payments, because cash purchases, excuse me, because she's going to have to pay for all her supplies to make her product in advance. Also, she figured that in month 9 she's going to need some help, right before Christmas, because that's going to be her busiest time of the year. So she factored in some salary to help to get 1 or 2 people to help her to make her stuff. Then she's also decided that she needs a place to do this. She's been doing it out of her home, but she's looking, okay, I'd like to have more space. Maybe don't need it, but I'd like to have more space. So let's look at that, look at rent. So they're under rent. She's got, $500 a month. Well, first month, they want first and last month to get started. So she got Oh, then you got your other expensive telephone, got some shipping, uh, got some, got advertising. You got to market yourself. And uh, you got some bank charges, credit card charges, and some miscellaneous. And oh, she decided she needs to make $2,000 a month out of this business. So okay, so she's factored in 2,000 a month for herself, and so go down there. You got sales tax payments, and look here, and start looking down there. And like I said, this is cash. This is the cash flow statement, and we look down there, and on the line that says cash flow, surplus, and deficit, um, all that red is not good. Just in case you were wondering about the difference in the color, red is not good. And she looked at it and goes, red every month until month 12. And then it turned positive to the tune of $1,435. Good to go. Well, except that we look at the year to date and still over $22,000 in the hole. So obviously, that little scenario is not going to work. So what we're going to do? Well, we're going to sit there and go, okay, let's do something different. I came out, I was in the hole 22,000. Get a business loan. Yeah, let's do that. So Kathy goes out and borrows $25,000 from a local or a friendly local banker. No, friendly banker is not an oxymoron. There's a lot of friendly guys out there. They'll loan you money. I've had clients in through past years that uh, their bankers were very friendly and loaned them just enough money to get them into trouble. So that's something you always have to be aware of. Know what you're doing. So we have a $25,000 loan, and then then that pesky little thing of loan repayment is has to be factored in there too. So same sales figures. There's the loan received at the top there in the $25,000, and everything else is the same. Got the rent, goes on and on and on forever. Uh, then we got all your advertising, the marketing stays the same. She's still paying herself 2,000 a month. Oh, and then there's that little pesky little loan repayment of $800 a month because this loan was going to be $25,000 over 3 years. So, which is pretty standard for a small business on a loan of that size. So, look down here and look at that cash flow surplus and deficit line again, which is the third line up from the bottom. And we look there and go, still got a lot of red. Even though we started out, I mean, the red numbers aren't quite as big, but they're still red until the 12th month and look down there, it's black, but we look at the end of the year, we're still in the red to the tune of a little over $7,100. So Kathy falls back, looks at this and goes, I don't think that's going to work either. So what she does is regroups, said, see what else we can look at here. So what Kathy does is basically, okay, number one, no loan. She's not going to borrow. And number two, she's not going to take any money out of the business. Going to have to let this business go and get established first before we start taking some money out of it. So what she has to determine is, does she have money to live on from other sources? And obviously in this situation, she does have. She has a significant other that has income. or she has some type of other income that she can live on. Now, she may not be living high on the hog, but she can survive. So what she does, we've got, this cash sales, all the same, uh, purchases, all the same. Nothing changes except that, and we're still going to have to hire that person in month 9 to help manufacture and make the products for the Christmas season. Uh, all that stays. Now we get down here on our draw, and you see there's 0. Not going to take any money out of it. So look down here, and there's obviously no loan repayment because there's no loan. So we look down here and look at the cash surplus and the deficit line, and there in month 9 and 10 got a little red, but before that it was positive or just evened out. So we end up the year, she ends up the year $7,950 in the black. So that shows that that scenario is doable. Now, that can happen, and and be productive and be profitable. Now, like I said, this is all she done this on one night. Just look at it and say, okay, what? And that's sometimes what you have to do. You have to look at different scenarios and make sure you're factoring in everything. Is this doable or is it not doable? Because every scenario you come up with will not be doable. But you can only determine if it is doable or not if it's based on not just information, but good, reliable information, and that takes some uh, thought and some effort. So every business is going to have times when your cash inflow and your cash outflow do not match up properly or exactly. And very rarely are you going to have so much coming in you don't know what to do. That's just not all that common. So knowing that there's going to be cash flow gaps, like Kathy did, said we have to prepare for that. We have to make some changes. So, but just knowing that they're going to be there, and we'll have to figure out through our forecasting when those gaps may occur. Nobody has a crystal ball, as I said before. So you just have to do your best work, your best judgment, your best guess. But there's basically only 3 ways you can fill those cash flow gaps. Those gaps in time when you need money, you need a cash infusion into the business. And that's one by trade credit. What that means is you go out there, instead of paying cash for your inventory or for your supplies, you talk to the people you buy your stuff from, your vendors, and say, hey, can you give me 30 days to pay? That way if you use that time, you buy your product, you get it, and then you pay them 30 days. You're using their money for 30 days. That is it's a good way to help manage your cash. You always use other people's money whenever you can. Uh, so that's one way. Problem of it is that's kind of short term, and you go beyond the terms that they provide, and you'll only get by with that for so long. They're going to cut you off. So just remember that. Bank loans, get a short term, maybe a long term loan, depending on what you're using it for. That's the way to fill those gaps. Aqua also equity infusion, and that's generally speaking, that's from the owner, business owner. has to put their own money into the business, which is done frequently in small businesses, or if you can find some investors. Uh, but preparing a cash flow forecast is the best way of predicting if and when these gaps will occur. Then, and how much will they be and when will they be? So those are just some things to be aware of. uh, then I like to talk about the cash flow blues, that what causes this imbalance, not having enough cash in the business. First and foremost, your fixed costs creep up. Fixed costs are your overhead costs. Your rent goes up. Utility companies decide they need more money because they've got to pay for disasters other places. Um, you know, all these things, all these overhead costs. You have your employees demand more money, or the minimum wage law goes into effect and raises it. There's a lot of things there that you obviously had no control over. Also, your variable costs get out of control. Variable costs are those things that will rise and fall with your sales. That's inventory cost is a good example, because as your sales go up, you're going to have to buy more to replace what you're selling. When your sales start declining, then you're going to buy less inventory because you have less to replace and you're not selling as much. So these costs will vary with your level of sales. Um, Sales are turning into cash too slow. This is a very real problem with accounts receivable collections. Um, this was something when I had my store. I was a retail store, historically cash business, but I did business with the city. I did business with the schools. I did business with all the businesses in the area, drilling companies, oil companies, uh, some manufacturing companies, different things like that. They do not operate on a cash basis. Therefore, I had to have receivables. They would come in there and say, "Yeah, give me this and this." No, put it on our bill. So every month, I was sending out statements, and in any given month, as much as 30 to 35% of my business was on receivables. That's a lot of money hanging out there in the wind that I've given inventory out for, but haven't got paid for it yet. So I had to keep an eye on those receivables, because if somebody goes past my terms were 30 days. Um, you I don't know if anybody's ever dealt with the oil industry, but in the oil industry, 30 days equals 180 days minimum. So, you're gonna wait on your money. That's all there is to it. So you have two choices. You either wait on it or you don't sell to them. It just depends. But anyway, you've got to understand how quickly those receivables are going to turn into money. Also, your inventory may be bloated. You've got inventory that you can't sell, and that could be due to it's the wrong type of inventory. You got too much for this time of year because it's a seasonal item. Uh, Maybe improper buying. Like I said, I had a retail store, hardware store. I did some stupid buying. I mean, you're going to make mistakes, and what you do, you just realize the mistakes and don't do it again. I've always said the smart business person isn't someone who never makes mistakes. The smart business person is someone who makes a mistake, learns from it, and never makes that mistake again. There's a difference. If you're not making mistakes in business, then you're not doing anything, and that'll kill you just as quickly. So also, and original capitalization is too small. you didn't have enough cash or access to cash when you just to begin with. And this is probably the number one reason why so many small businesses fail. They are undercapitalized from the day they first open their doors to start doing business. They don't have enough money in the bank or available somewhere else in order to, because I haven't done the forecasting, they don't really have a clue how long it's going to take them to get to the end of the month, to the end of the quarter, to the end of the year. So most businesses don't fail because they don't know how to do plumbing, they don't know how to sell stuff, they don't know how to make stuff. They fail because they don't have enough cash to get them through those cash flow gaps and those hiccups that will come as along the way. So from the basic rules, there's four of them that I always live by. Number one, cash is king. Nothing beats bucks in the hand right here. Money in the bank. Number two, cash comes from customers. You can get cash from other places, but you're going to have to pay it back. You don't want that. So understand where your money comes from and treat them that way. Number three, you must have more money coming into the business than you have leaving. You know, that sounds like pretty much common sense, and it is, but you'd be surprised how many business people don't grasp the concept. You got to have more money coming in than going out. So you do these things. And in the retail business, I always said you increase money in your business. Basically, number one, you you sell your product, raise your prices. That's if you've got a lot of competition, especially within your market area, not easy to do. You can't just go out there. When I had the retail store, I couldn't just say, "Oh, I want to make more money. I raise my price." You just can't do that. Got too much competition. The other way to make more money in retail or any business is to buy better. I bought my inventory at the best price I could find. Uh, I was always looking for better sources. If they were the same quality but a little cheaper, go there. Or I could get them by certain things, less freight. That made me more money, saved me money, I should say. So, buy better, buy supplies better, even over things that deal with overhead, office supplies, things like save money anywhere and everywhere you can. And, but also, reduce expenses. That's the number one thing. That's one thing you can really control. Um, Reduce expenses on what you pay for office supplies. Don't buy so much. Save money on anything, anything that you buy for your business. Look for and buy it at the best price you can get, and always be looking. Number four, you must know just how quickly your profits are going to convert into cash, and you do that by way of understanding that your income statement at the bottom line shows your profit, but that's not because that's an accounting convention instrument. It's not necessarily all in cash. So you need to understand the timing of your business that we've just talked about as to when that profit will turn into real cash. So, okay, that's all I've got for now. If you have any questions, I'm open, or I do want to thank you all for being here and listening to me for the last hour or so. Um, we're just we're skimming the top of this subject, to be honest with you, because I used to do a seminar, no, a 3-hour seminar and get in more depth and detail. But I'm available if you have any questions or if you want to talk with me. You can get hold of Lynn and she can get hold of me. Be glad to help. So thank you for your attention. I appreciate it.
Thank you, Bruce. All right. Well, if there are no questions, well, there was one thing in the show. Okay, I think it was just so. Oh, Nicole saying thank you. All right. Well, then I guess we will end the class for today. I'll send everyone the reporting probably tomorrow when it's finished processing. And hope you have a good rest of your day. Thank you, Bruce.
Thank you. And again, thank you all for being here. I appreciate it. I know Lynn does too.
I do. All right. Have a good day, everyone. Bye, Bruce.
All right. Thank you, Lynn. Bye bye, everyone.